The stock market is sending us warning signals, and we haven't seen signals of this magnitude ever since the dot-com bubble back in 2000. Now, back then, investors were looking at sky-high valuations and a crash that followed, wiping out trillions of dollars in wealth in a very short amount of time. Now, within the next 20 years, we are starting to see that same red light flashing in the S&P 500, which is my favorite fund to invest in. History suggests the next move in the next couple of years might not be too pretty. So what does it mean for investors like you and me? Now, right now, the S&P 500 tracks the 500 largest companies in the United States, and it is trading at an all-time high evaluation that we have not seen for an incredible amount of time. And this is actually at an evaluation that we have literally never seen in history. So when we look at the valuation, a lot of people are asking, and it's basically asking yourself, how much are investors willing to pay to see the companies and put dollars into the company's earnings that we're seeing? The higher the number climbs, the more stretched the market becomes, and that's exactly what we're seeing. So the problem lies in the past, the S&P 500, when it reached record levels like we have seen for this year, on the next one, possibly even 2 to 3 years that we'll look at, have seen negative returns. Now, we've seen this back in 2020. In other words, that means buying into the market right now might have not worked out historically for investors, and we might see it again. So what exactly happened when we think of the dot-com and really drawing the parallel to understanding when people started sounding the alarm? Let's go back to the late 90s when the internet was exploding. Everything with the dot-com, that is where it got its name, was just seeing the price soar. Anything you bought, it was going up. The NASDAQ quadrupled in just a few years. The S&P 500 were disconnected from complete reality because the big difference between that 2000 bubble burst, stocks crashed, investors panicked, and a huge sell-off for decades is kind of where stagflation came in before the market made a full recovery. But the thing that we're seeing that is a little bit different today is the S&P 500 book ratio is about 5.3. During that dot-com bubble, it was 5.1. So it is a little bit more expensive, but the big thing is the concentration within the companies. When we start looking at the 7 companies, also known as the Magnificent Seven, as they are better known, they make up over 25% of the entire S&P index. When you think of Apple, Microsoft, Nvidia, Amazon, Alphabet, even looking at Meta and Tesla, they are over 25% of the entire index, which is huge. When a few companies drive the market returns in the entirety, if one company or even 2 companies start to stumble, it can feel like the whole S&P is doing a major drawback, extreme evaluations, extreme corrections when it comes to just those companies. So looking back, even when we did see those extreme highs, typical year had a little bit of weaker returns. We are seeing the little bit of a weaker return right now. But during the dot-com, the S&P 500 fell nearly 50% over the next 3 years. Now, for me and you, that is a pretty big spike and a pretty big thing to swallow. But overall, if you're buying the S&P 500 at a 50% discount, that is kind of incredible. Now, of course, it doesn't guarantee that we're going to see this exact repeat. And some say this is even different. Now, the big reason and why I wanted to share this, because not all companies, not all evaluations, not all economists are saying that we are on the verge of disaster. And the big thing between the two is when we start looking at the stressed valuations, when we start looking at the fundamentals that we had in the year 2000, they did not, and this is the big part, did not have a lot of profits, did not have the earnings. When we start looking at the Magnificent Seven and breaking them individually, it is not just a hype. It is not just buying everything. They are companies with incredible profits. They are driving the industry. They're generating billions of dollars in cash flow every single year, deeply entrenched in technology, cloud computing, artificial intelligence. In fact, when you look at the AI models that we have today, they are one of the biggest driving force and really the coming to market with the AI. Now, again, thinking of that dot-com era, companies had almost no business model. Tech giants had almost no earnings, which is incredibly crazy. So a lot of people are actually saying the S&P 500 isn't dangerously overpriced. It is actually correctly priced. There could be certain companies, certain pockets that are a little bit over, but believing that AI is driving productivity, higher valuations, and the companies are still making money. So what do the experts say? When we start looking at Wall Street and looking at some of the large firms, Stifel, for instance, says the S&P 500 could drop as much as 14%. When you look at Evercore, we could be looking at a 15% correction. Even JP Morgan, which is a little bit more optimistic, is saying we could see roughly a 10% dip before we see some of the fittings. Now, if we remember the recalls or the drawbacks, whatever you want to call them, it is a normal part of the market cycle. We have seen this through all of history, which we're just going to look at in a minute. When we look on that, coupled with August and September are historically two of the weakest really months for the stock market overall. And it gives the ability for a number of stocks that are starting to rally. Some, and it seems like right now there are some very low and not a ton of companies that are really on fire. So how can you do with this information and where is it really beneficial? First of all, not financial advice. I am not a financial advisor. Do your own research, but there are some very easy ways to protect yourself when we see these market corrections. The big one being diversification, not putting all of your eggs in one basket. If your portfolio is overloaded with tech, if you have it spread into a lot of different sectors, you're going to have diversification in that portfolio. And of course, rebalancing, which this is something, if the winners have grown too large, timing them or scaling them back a little bit, taking a little bit of that profit could reduce your risk. Now, I know the CEO of Vanguard has said there's never a reason to rebalance the portfolio. So take it as you will and do your research. And then, of course, when we start looking at some of the defensive moves that people do, moving some of the portfolio into bonds, possibly even cash, even defensive stocks, some of those utilities, some of the consumer staples, we see a lot more of the portfolio that might not have as much high exposure to tech. And then when we think long term, going in, dollar cost averaging, like I said before, the market pullbacks are normal. Investors who stay very disciplined, this is a time, and really the perfect time, to make an incredible amount of money through dollar cost averaging. If you're going ahead and you're buying this through the drop, if we see 5, 10, 15, even a 20% drop, if you're buying it, there's going to be a point in time where the valuation and the market does come back. We've seen that through all of history, which is kind of crazy. So let's go ahead and hop over and take a look at the S&P 500, because this is very interesting to see on a historical chart. So since the stock market index, or the S&P 500, since the market index in 1927, that is right, guys, we're looking at almost 100 years that we have in here. And I'm just going to go back the last 50. You can see even the last 50 years, it was at 86. At this point, people were saying there was no way that the market would hit 100. And then just several years later, we are already well over 100. And then, of course, a lot of the economists, a lot of professionals said there is no way we are going to see a valuation in the S&P 500. That is up to 8,000. And there we go, guys. We just broke over 1,000 right about 1998. So right before that dot-com bubble, the S&P 500 did break 1,000. Then, of course, the dot-com bubble happened. Boom, you've seen a little bit of a drawback. If you were buying during this time, again, when the market's seen a really big uptick, would really build that portfolio. Those down markets are required for you to dollar cost average and put money in. Then we've seen the housing market drop. Boom, went down to 735 again, a very big pullback. And if you look, this was February 2009. So we're talking, looking at 16 years ago when we seen the housing market, 2008, 2009, when we really seen the impact in the market. And then it just shot up like crazy. I mean, you're looking again, 700 up to 1,000, 1,500, 2,000. Then we're looking 3,000, 4,000 up to 63.39, which I think 64.49 is what we're looking at in August 25. So even thinking of the valuation going back to that 2008, 2009 of the 700, we have almost grown 6,000 in here. And again, it's kind of incredible to think about, because when we start looking, even adjusted for inflation, I mean, it does make a really big difference on how fast this market has really shot up. And then looking over the last 50 years, when you look through here, what do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. We have 11 years that we have actually seen a negative drawback or an annual change of the S&P 500, 11 years out of 59 years. Again, when you look at the track record, when you look at history, it's pretty neat to see exactly how it's performing. And of course, all of these right here is your dot-com bubble. This is the housing market pullback. This is the recession in 2018. This, of course, is due 2022 during COVID. So there were significant, really global or US events that led to the reduction in the market and really the pullback. And then we look at the average price. This, again, is, to me, super interesting when you see just kind of the evaluation of just how it is a very, very steady rock climb. Even looking again, when you look in this area right here, where we did see kind of that drop within the dot-com, then the housing market, I mean, 2009, 2010, 2011, the market had already fully recovered from exactly and even went over and above where we were just 3 years prior. So again, giving you a really good opportunity to go ahead and invest in all of these companies and having the ability, again, to dollar cost average and understanding exactly how I turned a portfolio and building out my portfolio itself. We actually have over 100% return in the last 4 years. So let's sum it up, guys. So the stock market is showing you same warning signs we've seen during the dot-com bubble. This is going to be extreme evaluations, high concentration in just a few companies, but this also gives you a massive opportunity in the next 1 to 3 years if we see a pullback to continue investing in really pulling out the emotional aspect of it and making the logical decision to invest. At the same time, tech giants, far more profitable than we've ever seen them in history, right? Of our rise of artificial intelligence, creating real lasting growth in this company, and also the big drive for computers, CPUs, chips. Look at NVIDIA, absolutely crazy. So let me know in the comments, what do you guys think? Are we sitting in another bubble as it sits today? Do we think this might just be a beginning of a very new growth era and we're going to see it? But drop your comments down below. If you found it helpful, don't forget to like the video, subscribe to the channel, turn on those notifications, and share it with someone who needs this information as well. So let me know again what you think in the comments, and I'll catch you in the next video.